Okay, so we've planned out our business. We've accounted for inventory management. We've accounted for accounts receivable and accounts payable. We've incorporated a fixed asset. We bought our candy cart to haul around and sell our candy out of. We accounted for the depreciation on that. We also added a loan. That way we could finance the purchase of that cart. We've accounted for our taxes. And our business is going really well. Things are going to go well over the course of the year. Assuming they do, investors are going to be interested in putting some money with us. Right? So we might want to raise some equity. So at this point, we're starting to think about crowdfunding. We're going to go out at the end of year one and raise $10,000 from a crowdfunding website. All right, so we need to figure out how to account for that on our balance sheet. It's not going to affect the income statement at all because it's raising capital. It's a balance sheet item. We just need to figure out where to put it on our balance sheet. All right, so we have our equity raise. It's going to be right alongside here in retained earnings, right? Retained earnings is one way we build equity, right? Essentially, we've made money over time, and so that builds equity in the business. The other way is just have equity inserted into the business. When people invest in the company, right, in an equity sense, that's where the equity account or common stock account shows up. When investors invest via debt, that's where we saw the long-term debt that we saw earlier. So now we need to add one more line to our model. We're going to make a little bit of room here, and we're going to call it the common stock line. So common stock is what we're going to raise in our crowdfunding campaign. We're going to start out with that thing being equal to 0. Let's go ahead and layer that on. And remove our borders just to make, again, look clean. And now the way we're going to link this one is simply reference our input with the previous account balance. So again, balance sheet, we're always going previous account balance plus any change. In this case, the change is that we're raising $10,000. So we have $10,000 of equity coming in. Now to update our financial statements, we just have to make sure we include that in our total equities and liability. So let's go ahead and click there. We now added that account in. It increased our equity and liabilities to $14,975. So did our total assets. And now that we see we have a lot of cash in our bank account. So what can we do at the end of our first year? We can buy a few more carts, hire some employees, and expand the operations of our business over the next year. All right, so let's recap what we've done. All right, we started out with a very simple model of a balance sheet with just cash and retained earnings. We slowly added on accounts to expand that balance sheet. The same with the income statement. We started with sales and costs. We refined those to cost of goods sold, added in a depreciation expense for the use of our fixed asset, incorporated interest costs on our long-term debt, paid for some taxes, and we're left with net income at the end of the day. All right, so we've built all that up. Importantly, the big thing to remember on the balance sheet is that we want to plug for cash. So just to review this, the way we're doing this is we take the total equity and liabilities. We know that has to balance with the assets. So we're going to subtract out every other asset except for cash. So we subtract out net PP&E. Notice we're not subtracting off gross and accumulated depreciation because they're already netted together in the net property, plant, and equipment. We're then going to subtract off each of the individual current assets. Inventory and accounts receivable are the current assets that are not cash. If you were to subtract off current assets, well, cash is included in that, and you're going to get a circular reference. That's not going to work. So we got to subtract off each other individual account that we have, and then we're solving for cash. All right. So admittedly, this is a way to plug for cash, and there's chances that we could make mistakes along the way. In our next set of videos, we're going to look at adding the statement of cash flows, which is going to give us a way to check that that cash balance we calculated is actually accurate. All right, we're going to plug for cash on the balance sheet and then double check that we're right in that statement of cash flows. We'll just leave that to the next set of videos.